Have you ever noticed how Bitcoin's price starts to move, sometimes pretty dramatically, the second the Federal Reserve even hints at changing interest rates? Well, today we're going to break down exactly why that happens and what it really tells us about the entire financial system. You know, it's become a really clear pattern. A whisper of a policy shift from the Fed doesn't just nudge stocks and bonds anymore. The crypto market, and especially Bitcoin, it reacts almost in real time. We're going to trace this whole ripple effect right back to the source. So that gets us to the big question, right? Why on earth does a central bank announcement have such a huge impact on a supposedly decentralized asset like Bitcoin? I'll tell you this, it is not random volatility. There's a clear, systematic connection going on here, and by the end of this, you're going to see exactly how it all fits together. So, what happens in those first few moments after the Fed sends a signal? It all happens incredibly fast, and the sequence of events is almost always the same. The very first thing to move is the bond market. I mean, instantly. Investors start shuffling their portfolios based on what they now expect for interest rates. You'll see yields go up or down, and that's just reflecting what everyone thinks the future cost of borrowing money is going to be. And right on the heels of the bond market, currency traders jump in. The value of the US dollar begins to shift because, well, those new interest rate expectations change everything. And whether the dollar gets stronger or weaker has massive implications across the entire global economy. And then, almost at the same time, Bitcoin's market gets a jolt of volatility. It's become part of this rapid-fire chain reaction, moving in near lockstep with the most traditional financial assets on the planet. And here's the key insight. This isn't just a bunch of traders gambling on where the price is headed. These reactions, all of them, are fundamentally about one thing: the expected availability of money. It's about liquidity. And that idea, right there, is the critical link we're about to explore. Okay, so let's slow down a bit and really follow the money here. We're moving on from the what happens to the why it happens. This is the underlying engine that connects a simple statement from the Fed to the price swings you see in an asset like Bitcoin. So here's how the chain reaction works. It all kicks off with a signal. Let's say the Fed hints at cutting rates. The market hears that and thinks, okay, more cash is about to start flowing into the system. That's increased liquidity. And when money is cheaper and easier to get, investors, well, they tend to get a little bolder. They develop a bigger appetite for so-called risk assets. And that search for higher returns is what fuels all the market volatility. Let's just pause for a second and make sure we're crystal clear on this term liquidity. All it really means is the amount of available cash sloshing around the financial system. So when the Fed lowers interest rates, it's cheaper for banks to borrow money, so they lend more freely. They're basically turning on the tap, and that increases liquidity. And this is where Bitcoin slots right into the picture. It's super sensitive to both of these forces. It's viewed as a risk asset, so when investors are feeling confident, capital flows in. But it's also really sensitive to those capital flows themselves, meaning it reacts pretty strongly to any change in global liquidity. Now, you should know this sensitivity is actually a pretty new thing. Bitcoin hasn't always been so tuned into the Fed. Its market structure has gone through a fundamental change, and that's made it way more responsive to these traditional macroeconomic forces. There are really three big factors driving this shift. First up, you've got massive institutional participation now. We're talking pension funds, hedge funds, big corporations are in the game. Second, you have regulated ways to get access, like ETFs in the US, the UK, and Canada, which open the floodgates to mainstream capital. And third, and this is a big one, these major players trade based on macro expectations, not just on crypto-specific stories. So you can really see the contrast between the past and today. Bitcoin volatility used to be this chaotic, isolated thing, driven mostly by crazy amounts of leverage inside the crypto ecosystem itself. Today, it's much more of a systemic adjustment, driven by global liquidity. Now, that doesn't mean the volatility is gone, not at all, but it's become more channeled, more predictable in how it responds to these big macro events. So, what does this all mean when we zoom out and just look at the big picture? Well, the way Bitcoin reacts to central bank policy, it reveals a completely new reality about its place in the world. And this, right here, is the single most important takeaway. For better or for worse, Bitcoin is now deeply woven into the fabric of the traditional financial system. It's not some outsider asset operating in a vacuum anymore. It's part of the global machine. So, just to put a bow on it, Bitcoin's price is now heavily influenced by the same forces that move stocks and bonds. We're talking central bank policy from the Fed, the overall conditions of global liquidity, and the expectations of huge institutional investors. If you understand this framework, you can explain most of what's happening with Bitcoin's price today. And that leaves us with a really big question to think about. As Bitcoin gets more and more intertwined with the global financial system, is its famous volatility actually becoming more chaotic and unpredictable? Or is it becoming more structured? Is it being channeled by the same powerful economic forces that govern every other major asset? That's a fundamental question about the future of this asset, and maybe the future of money itself.